201. Thank you for joining us today. Today's topic is going to be Investing and Finances, a masterclass taught by Amy Mutal of Prevail Wealth Management, who's the sponsor of this event for today, and it is free and part of our community education series. So welcome, Amy, financial advisor with Prevail Wealth Management.
Thank you. It's good to be here. Thanks, Samantha. I appreciate it. We'll go ahead and get started. I'm going to plug in my PowerPoint. Can everyone see that okay?
Yep.
Yep. Okay, fantastic. So we are going to dive in. So Masterclass, the 7 investing principles. Again, my name is Amy Mutal. I am the principal and primary financial advisor of Prevail Wealth Management located in Kirkland. And I'm excited to take you guys through the fundamentals that you'll need for investing success. So we'll go ahead and dive in. We're going to start with the investing number 1. Before I do that, I want to let you guys know we are going to have time at the end of this presentation for questions. So as we go through the 7 principles, please jot down any questions that you have. And at the end, we'll give you time to ask those questions. If for some reason you don't have the opportunity to ask the question that you have, you can feel free to contact me at Prevail. Also at the bottom, you'll see this www.prevailwealth/chamber.com. That is a link specifically set up for those that are viewing this presentation. If you go to that /chamber, the Prevail address, it'll take you to a scheduling link that will allow you to schedule a 15-minute session on the phone with me if you have questions that you would like answered or need any additional guidance. So feel free to take advantage of that. So we'll go ahead and jump in. We're going to start with the number 1 investing principle, which is establish a financial plan. So establishing a financial plan, I say, is one of the really most important core things that you need to do. I would even say before you start investing, or if you already are investing, this would be a great thing to make sure you stop and evaluate a plan or create a plan if you have not yet done one. I also feel that this is a really great reason to get a financial advisor if you don't have one, because they typically are masters at creating financial plans and helping you to make sure that you're on track to achieve your goals. So with a financial plan, you want to make sure that your goals are realistic, that they're achievable, that you review your plan at least annually, and that you make changes as your life circumstances change. I always refer to a financial plan as an active, living, breathing plan. It evolves constantly. It's something that you want to take a look at annually. You probably have goals that you haven't even thought of yet that will come as life continues to evolve. And then life, as we know, can also throw curveballs. So it's important to make sure that you are evaluating your goals in your financial plan on an ongoing basis. If you get too far away from your financial plan or you set a plan and don't look back and review it, often you'll find once you do get back to it, so many things have changed and maybe your plan has gotten off track and you don't have the ability to correct that. I also feel that financial planning is so incredibly important for investors. I want you to think about it as if you were taking a road trip. If you were on a road trip and you're going across the country, let's say, and you've never been before, what would you do? You would put the address into your GPS and you would let the GPS tell you what roads to take, what turns that you need to take, what freeways to take along the way. And if you hit construction or speed bumps or some type of detour, what does the GPS do? It will actually reroute you and get you back on track. So financial planning is very much the same way. If you have a curveball in life or you get off track, the financial plan and doing a review there will help you to get back on track to make sure that you're still able to meet your end goals and get to your destination. Successful financial planning can help to propel your net worth. In a study recently of Americans over the age of 50 who were successful at planning and stuck to their plan, they were able to achieve a total net worth 3 times higher than those who didn't plan at all. So if you look at this chart here, someone who never planned versus someone who had a plan and stuck to it, you can see that what they were able to attain in net worth is a significant difference. So that's just to illustrate the importance of planning. Principle number 2, start saving and investing today. It's never too late to start. They say that in our 20s, we start hearing about investing. In our 30s, we start thinking, I probably should get to investing. And in our 40s, we begin to panic that we haven't gotten a plan going, an investment strategy. But I say it's never too late to start. You can start anytime, and it's better than not starting at all. Maximize what you can afford to invest. So this is looking at your budget and your cash flow. What do you do with that cash flow? How do you put that cash flow to work to help you fund your goals? And then time in the market is key, not timing the market. So we know that trying to time the market is nearly impossible. People who get into day trading or trying to make investment decisions based on timing what they think that investment's going to do or what the stock market's going to do often fail. So it's about being in the market over time. That is how you're going to build your wealth. So you want to start now, and you want to make sure you're doing a budget and a cash flow analysis to determine how much you do have to invest, and then getting in some quality investments and staying in the market. It pays to invest early. So we're going to take a look at 2 scenarios. One is Marie and Anna. These 2 women we'll use as an illustration. Each of them invested $3,000 every single year on January 1st for a total of 10 years, regardless of whether the market was up or down. They didn't pay attention to where was the stock market at that January 1st date. They just put their $3,000 in religiously. But Maria started 20 years ago, whereas Anna started only 10 years ago. So although each investor put in a total of $30,000, by 2017, Maria had about $30,000 more because she was in the market longer. So time in the market really does pay off. The sooner you start, the more wealth you'll build. Don't try to predict the market's highs and lows. Like I said, timing the market is nearly impossible. People who do brag about getting into a particular stock at a certain time and doing really well with that often just got lucky. There's just as many or even more people who didn't get lucky, and those are the ones you don't typically hear from. But timing the market is very, very difficult. As you can see here, 2009, for those of you that have been investing for a while, you may remember 08 and 09, very volatile years. Many investors were really tempted to get out of the stock market. I was a financial advisor back then as well. I had a lot of my clients that I had to talk off the ledge and keep them in the market. Another important role a financial advisor can play is to help take the decisions out of these investment decisions that you're making and help to take the emotion out of the decision so that you don't make costly mistakes. And this is an example of where someone might have made a mistake. If the market was getting volatile, they get nervous, they try to jump out or want to jump out. And for an example, if you had invested $100,000 on January 1st of 2009, and you missed the top 10 trading days of that year, you would have had $43,000 less by the end of that year versus if you just stayed invested. So what this chart is showing is if you just miss the top 10 or 20 or 30 or even 40 days in that year, what it can do to eroding your potential of growing versus someone who just stayed invested and went through the ups and downs, got through the volatile period and just stuck it out. They ended up with the most value in the end. So timing the market and getting out when the markets are dropped are often mistakes investors make. Build a diversified portfolio. You want to know your comfort level with temporary losses. You want to know what you can stomach and what keeps you up at night, and just what your tolerance is. You want to understand the asset classes can behave differently, and understanding that asset classes can behave differently can help you to build a portfolio that actually will weather volatile markets. And don't chase past performance. This is a mistake I see a lot of investors make. They will look for the highest performing returns in that sector and try to get into those sectors. They're chasing past performance, not knowing that maybe this particular sector going forward is going to go through a downturn. So be careful of not chasing the performance. Asset classes perform differently. This is a great illustration. We're going to look at what large cap equity versus moderate allocation versus fixed income and cash equivalents perform. So $100,000 invested in 1997 would have a very volatile journey to nearly $400,000 in 2017. And that is if invested in US stocks. So you can see down here, 1997, this blue line represents large cap equity. You can see that it does really well. It went to $400,000 by 2017. But look at this ride. It is volatile. It is up and down and with some sharp drops along the way. Now on the flip side, let's look at cash, is the red line. Very smooth, barely moves. You don't have the same upside potential, but you certainly don't have the same volatility either. So those are the extremes between large cap equity and then something more completely conservative, which is cash. And then let's take a look at fixed income. More conservative, this would be your bonds, for an example, bond funds. Smoother ride, definitely has opportunity for growth, but not nearly as much as the stock market. A moderate allocation would be somebody who has a combination of these asset classes, which is the orange line. You can see a little bit of volatility, but much smoother than large cap equity was. And look at the performance in the end. Not far off from the more volatile ride that stocks represented, to have a more smooth ride with a moderate allocation mixed portfolio. We're going to take a little bit closer look at this. It's nearly impossible to predict which asset class will perform best in any given year. This jelly bean chart is what we call this. You can see it's multiple asset classes, all kinds of different, anywhere from emerging markets to fixed income and tips to cash. You can see all these different sectors, and there is no pattern here that you can predict or be sure of will be consistent in how it performs. Matter of fact, if you're chasing returns, look back in 2009, somebody might have said emerging markets, 78.5% returns. That's what I want. I'm going to get into this sector. But look what happens over time. Just even a couple years later, it's your lowest performing asset class, or your performing sector, lowest performing. So you can see that what becomes can be your highest can also be your lowest the very next year. I always say, who cares how many home runs you hit in an up market if you strike out in a down market and have to start the game over? What would be smarter is to have a well-diversified portfolio of all mixes of all these different asset classes, so that you're not trying to guess what's going to perform best or what's going to be the worst performing sector, but you mix all the sectors together, and this white box represents a diversified portfolio. You can see it's a much smoother ride. It rides along in the middle. And you'll find, statistically speaking, that a diversified portfolio in the end will be worth more because it didn't have to strike out in the bottom markets and spend all the time to recovering to get back to compound growth and interest. And we all probably have heard the key to building wealth is compound growth and interest. So the more time you have to your portfolio growing on top of itself year after year, the more it will be worth in the end if you don't have to strike out and have to start the game over and spend all these years, sometimes up to 2 years in some cases, just trying to recover what you'd lost. So smoother ride is key in the end. It's also very important that you know what your risk tolerance is. This is going to be how you feel about market conditions and how the markets are performing. Why this is so important is it helps you to set the expectation and know what to expect when the markets do get volatile. There's ways and assessments that you can do online to determine what your risk tolerance is. There's also ways that you, working with a financial advisor, can help you assess what your risk tolerance is. So there's different ways to determine this. It's based on also your time horizon and the objectives of what you're trying to achieve. And so a portfolio that's higher in stock will have more volatile more upside potential, but that same portfolio that's higher in stock will also have a deeper drop. So understanding what your tolerance is so that when these down markets happen, and they do happen, we know for sure they're going to always continue to happen, the more comfortable you are with your risk tolerance and knowing and understanding that will keep you from wanting to jump out of the market when things start to get a little bit more volatile. So just understanding that is key to being able to stick to a good quality plan. Minimize fees and taxes. Markets are uncertain, fees are certain. You can control the fees you're paying for your investment, so that's super important to look at. Pay attention to net returns. Don't be wooed by investments that give you high returns. You want to know what is their returns net of expenses. So always look for that net of expense return. and minimize taxes to maximize your returns. I like to say that if you are investing in a tax efficient way, you don't have to give up some of your returns to the IRS if you're doing it right and being conscious of being tax savvy. Fees can eat away at your returns. And here's, again, our examples, Maria and Anna. We can see that with Maria, with a investment type, or it could be a mutual fund or some type of investment structure where she was paying 1.5% versus 0.75 management fee versus no fee at all, you can see the difference in the growth of her initial investment of $3,000 over 10 years. And same with Anna. So if looking at her portfolio, again, remembering Anna has a little bit less because she didn't have as much time in the market. If you think about the other illustration we showed, being in the market longer is better. So again, it does erode your returns if you have high expense or high fee type investment products. So be conscious of that. Try to minimize taxes and also use your tax divert options. If you have a company 401k or IRA, if you're self-employed and eligible for SEP 401k or simple IRAs, these are types of accounts that you can invest in. Same type of investments you would use in a regular brokerage account. But the benefit is these are tax sheltered and deferred. So you can see the difference between a tax deferred investment versus a taxable in the end will grow to be worth more because it's more dollars compounding over time. So be really conscious if you have the option at work of a 401k plan, make sure you're taking advantage of these tax deferred accounts for investing. All right, so number 5, protect against significant losses. Modest temporary losses are okay, but recovery from significant losses can take years. Use cash investments and bonds for diversification to provide some downside protection and to smooth out your portfolio performance over time, especially during volatile markets. And consider options as a hedge against market declines. Certain option strategies can be designed to help you offset losses. If you're going to do this type of investing, I do highly recommend you work with an advisor who's skilled in this area. But there's ways that you can leverage your investments within your portfolio to provide a non-correlated response or performance to make sure that you're capturing the upside of the markets. But when markets get volatile, you have some downside protection as well. Steep declines are hard to bounce back from. So in recent downturns, an all-stock portfolio took longer than a diversified portfolio to return to its peak prior levels. If we look at this, we can see here that this light blue line is an all-stock portfolio. The bright blue line is a blend of 60% stock and 40% bonds. A lot of people think, why do I want bonds? Bonds sit flat or they're not as exciting as stocks. They really can be your downside protection. You can see that by having a diversified portfolio of stocks and bonds, that it took in this drop here, we're looking at the range 2001 to 2003 or 2004 era. This was a diversified portfolio took 42 months to bounce back, where a all-stock portfolio took 72 months. And again, here's another time period in 08 and 09, the financial crisis, was a 36 months to recover for a diversified portfolio versus 53 months. So if you can see that it takes, having downside protection means that you recover faster. Again, the sooner you get back to your baseline, the more years and more time you have to compound growth and interest, the more value your portfolio will have at the end. So it's all about having an ongoing compound growth and interest and minimizing that downside loss and getting back to recovery or to par sooner. Defensive assets have performed better when stocks break down. So remember, I just said some people say, why would I want bonds? That doesn't make sense. They're not exciting. I want stocks. And I see that stocks do grow more in up markets, et cetera. That's all very true. If you look at the cash, and we're going to look at several conservative or downside protections or other asset classes. So we're looking at US stocks compared to cash, treasuries, international bonds, and precious metals. So we're going to look at 2002 as a down market period and 2008. And you can see in both of these time periods, stocks were down 22.1% in that same period, All the other safer investments were actually up an impressive amount. This is the downside protection I'm talking about. And the reason that this happens is when the markets get volatile and people are fleeing out of equities because they're nervous, they're going into bonds and these safer instruments for safety and for protection. So it's supply and demand. As more people or money's pouring into these safer investments in a volatile market, they become more valuable. So if a portion of your portfolio contains these type of asset classes, you can see how effective they are in a down market in providing you some growth, so that whatever part of your portfolio is decreasing, a portion of your portfolio is becoming more valuable. And that's where you end up losing less in the down market, which means you get back to recovering, back to par, and back to compound growth and interest sooner. All right, let's see. So rebalance your portfolio regularly. Be disciplined about your tolerance for risk. Stay engaged with your investments. Understand the asset classes behave differently, and just be prepared for that. Make sure you understand how the different asset classes in your portfolio are designed to perform. Steep declines are hard to come back from. A portfolio began with a 50-50 allocation, so this is a matter of rebalancing. You can see that in 2002, you started with 50% stocks and 50% bonds. Over the next 5 years, the portfolio drifted to a 60-40 allocation and was positioned for larger losses in 2008 than it would have experienced if it had regularly been rebalanced. So if your risk tolerance says you should have a stock portfolio 50% and bonds represent 50% of your portfolio, and that's how you set it in 2002, and you didn't rebalance it or look to get that back into your original allocation over time, you would have drifted just simply by the market movements to 60% stocks and 40% bonds. So if the 50-50 was your risk tolerance to begin with, but your portfolio drifted in 2007 to be 60% stocks, and that next market, as we know, 08 and 09, we took some really big dips there. If this portfolio would have ended up performing much more volatile than what your original risk tolerance would have tolerated. So you want to make sure to rebalance to keep your asset allocation in original alignment of what your risk tolerance and your time horizon is for investing. Okay. Ignore the noise. This is one of the most important lessons I share with my clients. It is so easy to get caught up in the hype of the media. And remember, the press makes noise to sell advertising. Markets do fluctuate. I always laugh when I listen to the news sometimes, and it'll be the market's plummeting and it's down 1%, or the market's soaring and it was only up 1.5%, really normal market movements. But the media likes to exaggerate. And if you get caught up in that noise, you can find yourself making costly mistakes, because we do know that emotions will drive your investor psyche to do opposite of what you should be doing. When the markets are soaring, people want to get in. When the markets are dropping and getting volatile and plummeting or getting beat up, as the media might say, people get nervous and want to jump out. And we all know it's about selling high, buying low, but your investor psyche, if you get caught up in this noise, will drive you to do exactly opposite of that. So be very careful not to get caught up in the noise. Markets will fluctuate. Stay focused on your long-term objectives. Do not let short-term market volatility take you from your long-term focus. That's where a lot of investors will make mistakes. And again, if you think back to the earlier slide, an investor who stays invested and stays focused on their objectives and their plan will be much more successful than the one that's trying to time the market, or that's getting emotional and getting in and out of the market and trying to figure out how to play that day-to-day short-term fluctuation. It's impossible to do, and it'll end up costing you in the end. So stay focused on your plan and you'll do great. Progress towards your goal is more important than short-term performance. And this is just a last illustration of that. Over 20 years, markets went up and down, but a long-term investor who stuck to their plan would have been rewarded handsomely. If you look at this chart, these are all the different I would say some of the big downturn markets that we've seen. Some of you that are watching this presentation may not remember some of these markets. Other of you will be, oh yeah, I was an investor at that time, I remember it well. If you look at this chart, these different points in times that presented volatile markets, you can see when they start to drop, if you get nervous, let's say 2001 through 2002 when the tech bubble burst, if you got nervous and got out of the market, look at this run up that you would have missed. 2008 is another wonderful example of this. 2008, we can see the market starting to slide. Look how far it dipped, and trust me, my clients were uncomfortable during this time. But if they had gotten out and sat on the sidelines, they would have missed this entire run up. And look at where the markets are now. So people who stay invested are rewarded for doing that instead of trying to time the market or getting out when things get volatile and they get nervous. All right. So I'm going to open it up to questions. Samantha, I'll let you go ahead and lead that, and I'll answer any questions that you have.
All right. Thank you so much, Amy. This is really interesting information. We will start with if anybody is on the Zoom with us, and we've also got folks joining us on Facebook Live, but let's start with the folks on the Zoom. If anyone has any questions, please feel free to go in now. Brenda.
Amy, thank you. That was a lot of good information. Could you speak to fees? Like what can one expect for fees?
Sure. So I always say that fees are only relevant in the absence of value. So what I mean by that is if you're evaluating, there's all different types of investments and the different fee structures will vary. I would say this particular area is one of the most complex when it comes to investing. So for an example, a mutual fund, we'll just take an average asset allocation mutual fund. You want to take a look at that mutual fund and understand what its expense ratio is. How much does the money manager of that mutual fund charge to manage the investments in that fund? And some investments might be higher in expense ratio for justified reasons. For an example, a global mutual fund has a lot more expense to run that fund because of the research based on global companies. It's more for the company to go out and vet the companies within the stocks that they're using within the mutual fund. So a global investment might have a higher expense ratio than a domestic mutual fund. However, there are ways to compare how that mutual fund is in terms of its fees compared to its peers. And you also want to take a look at what type of performance does that mutual fund offer. So if the mutual fund is a little bit higher in expense ratio, but it has better performance than its peers, you might say that one would be worth having because it's the fees offsetting, or the performance is offsetting the fee. But generally speaking, you want to be cautious not to be in any high expense investment because there are other good quality options out there that can be lower in fees. So you have, if you're working with a financial advisor, you have the management fee that they may charge, and that's all. There's so many different ways that fees are structured. So it's important to evaluate it from every level and then compare it to its peers and other options to make sure you're not in something that's considered too high or not performing at a level to justify the fees. This is one area I think where financial advisors really do provide a ton of value because it's such, we won't even get into because we don't have the time here, but there's all kinds of different share classes that cost different. So the same investment, but different share classes can make it so that it costs different for an investor to get into that investment. These are things that they're just, unfortunately, it's a very complex part of our industry. Having professional advice in here can really make a difference. So, and I can answer this question if anyone wants to contact me offline. I'm happy to go into this deeper. So good question. Thanks, Brenda.
Thank you. Any others on the Zoom? We do have one on Facebook, but I'm going to see if there's any others on the Zoom first. No? Okay, so from Facebook, could you go over the criteria to calculate risk tolerance again briefly, please?
Yes. So risk tolerance is typically determined on your time horizon and your objectives, I should say. So whatever your objectives are, what you're trying to achieve. Everybody has a different risk tolerance, and there's tools out there that will help you to assess your risk tolerance. Different companies and different risk tools will use different methods to determine what someone's risk is. But an example would be that you would go into a questionnaire and it would ask you a series of questions. And there's a methodology that they use to determine based on how you answered the questions, what would your risk tolerance be? So for an example, it's going to show you different market performance and different conditions. And you're going to say, if you had $100,000 investment, would you take the risk to see in a down market lose X amount in order to have the opportunity to gain X amount in an upside market? So it takes you through a series of different questions to drill down on how you feel and how you respond to market volatility. And we all know that the more risk you take, the higher the payoff. But the more risk you take, the deeper the drops when the markets get volatile. So it's all about what's that risk and reward to you. It also is driven, risk tolerance is also driven by your time horizon. Someone who's much younger and has many years to invest and has many market cycles to get through, they can tolerate more risk because they have more time in the market to get through and make up for any downside. Somebody who's nearing or in retirement may not want to take that same risk. Once you're retired, you don't want to take big drops in a down market, even though you're going to give up some of the high returns in the up market, because you don't want to have to go back to work per se if your portfolio took too much of a hit. So it's all about not only how you feel about market fluctuations, and but also what your time horizon is and where you're at in your investor stage or your life stage.
Great. We are starting to get some more questions coming in, so this is great. Thank you. Can you explain a little bit about shorts? How does shorting stock work, and is it ever a good idea? It seems fairly risky, but good to know about that.
So shorting stock is something that I would say it's an alternative way in terms of investing. It depends on what type of investments you're using or how you're leveraging. It depends on what your purpose is in terms of, it's a pretty complex area of investing. This is one that I would say, and we saw, for an example, with GameStop recently, how the big hedge fund managers that were shorting stock got caught with their pants down per se. It can be a very risky strategy, but it can also be an effective strategy in terms of providing downside protection or non-correlated investment strategies within your portfolio. This is one area, because of the complexity of it, that I would say I would be happy to speak with you one-on-one if you want to contact me, because it really depends on how you're shorting stock or what the purpose is of that you're doing it. It's really a complex area that's outside of the realm of just normal portfolio construction. So I'd be happy to talk to you about that again, or one-on-one if you want to contact me, and so I can understand specifically what area of shorting and that type of investing you're inquiring about. So
great. Another question: is it a good time to invest in bonds if the yields are so low?
So this is another tough question, and I would say that with interest rates being pulled near zero for so long, as the government has been trying to keep and prop up our economy and keep us from being too deep into a recession, this is a way that they control inflation and help just to prop up the economy by pulling interest rates back. And we've been near zero for so long, that affords us a lot of great opportunity with low interest and mortgage rates, etc. But it really does make it difficult in the bond market, or it makes it difficult to park cash or find a place to earn any kind of yield in a conservative investment. I think that short term, looking at investing, it depends on if you're doing bonds or you're doing some type of investments around securities that are treasuries, bonds, things like this. You want to do what's a ladder. You want to try to protect yourself by not going long in these type of investments, because as interest rates begin to go up, and they eventually will, if you're in a long-term bond, for an example, with a short interest rate, that's not going to be a positive thing. So shorter term bonds when interest rates are low with the potential that interest rates are going to increase would be something to look out for. But there is also another place for bonds. Bonds don't always, if you're not in it to get interest, or you're not retired, you're not looking for a fixed income per se to live on, but you're still working and you're using bonds for downside protection in your portfolio, we still do know that that part of your portfolio does still serve well in a volatile market. When people, again, are fleeing out of stocks, they're going to safer investments, bonds and fixed income per se will still provide that downside protection. So it really depends on what you're using the fixed income for. Are you retired and looking for income, guaranteed income? Or are you looking for downside protection and having a diversified portfolio? So there's two purposes, and both these things need to be evaluated to determine what is the right strategy for your portfolio, given what your situation is.
Great. How would you advise someone who is considering investing for the first time, but worries about investing at the very top of the market?
Another really good question. And that is something I would say that is on a lot of people's minds right now. And let me give an example of some of the conversations I've had, especially with newer investors. They will say just exactly what this question is the market's at an all-time high. I'm nervous if I get into the stock market, it's going to drop and I'm going to take a hit. So I always use you want to be smart about how you're investing, but I always use the analogy that if it's about how long you're in the market, not trying to time the market, I say invest when you have the money available. Why? Because you don't know what the market's future is going to hold. There are so many times in recent history that I've had clients that will say, I want to wait until the market drops. And here we are. This was back at, let's say, 25,000 points, right? And now here we are above 31. So really trying to predict and figure out when the market's going to drop again. For people sitting in on the sidelines trying to time that, often they have to sit out on the sideline as the market's going up and keeps going up. And then what happens is that the market has to drop quite a bit to even get back to that point in time where if you'd just gone in, you would have captured that point in time in the market. So if you have the money available and you're a long-term investor, there's no reason not to put it in the market. Just make sure you're well diversified and make sure that you are building a good quality portfolio. If you're in the stock market for short term, in other words, I always say, if you don't have 5 years to be in the market, I wouldn't even go into the stock market right now, because there's a chance that when you need that money out, let's say, for an example, you have money and you're putting it in the stock market, but in 2 years, you need it back out for a down payment on a house. Well, we don't know if in those 2 years when you need the money back out, if the market's going to be in a down cycle and it's going to be worth less than you started. It's just too risky if you're a short-term investor. Long-term investors, I say, put it to work. Don't worry about the short-term market volatility. Keep focused on long-term objectives. Have a good financial plan, and you'll do well. Short-term money, yeah, I would say that I would probably avoid going into the stock market right now if you don't have enough time to actually truly make sure you're going to have some growth.
Great. What are your thoughts on working with multiple financial advisors versus putting all of your money into one advisor?
That's also a very good question. I haven't heard that one for a long time. I think there's pros and cons to both, to be honest. I think it depends on where you're at, what the type of assets that you have, how many accounts do you have, what type of investments do you hold. One way to diversify is to have another financial advisor with a different perspective. However, the downside to that is that you might not have your left hand talking to your right hand. So for an example, one investor might be working, or one financial advisor working with an investor might be building a portfolio and have it well diversified in all different asset classes and sectors. And if the other financial advisor is not working with let's say there's two different financial advisors, if the second financial advisor is not in cahoots or working with the first financial advisor, they might be building something similar. And if you look at those two portfolios together, you're going to have overlap. You might be too high in one sector, have too much exposure in a particular asset class. And that's because you have two investors or one investor working with two different advisors that aren't really speaking to each other. So I really think it depends on the situation. But for the most part, I think what's most important is to find a financial advisor you trust, that you feel that listens to you, understands your goals and objectives, that is helping you to educate you about your investments and what you own so that you become a savvy investor in the process. And that really it becomes down to that trust. But I wouldn't say it's a right or wrong to have multiple advisors. I think that you have to really think about the purpose of having multiple advisors and make sure that you're doing some type of evaluation to look at everything aggregated so that you don't have some of the issues that are common in that situation, like overlap or overexposure with your overall portfolio.
Makes sense. A couple more questions. Is it safer to invest in index funds? And what about VTSAX?
Yeah. So index funds. I would say that if you're going at it alone and you don't have the ability to do the research necessary to follow different sectors, doing an index fund is a great way to make sure you're going to do no better, no worse than whatever index it is that you're tracking. So if it's the S&P 500, you're going to do just as the S&P 500 is doing. Index funds are also typically very low in expenses, so it's a great affordable way to invest. However, if you are working with a financial advisor is going to look to do a combination of index or ETFs or mutual funds or individual stocks, whatever their strategy is or their philosophy. And they're going to look to build a portfolio that's more custom and one that's regularly managed and monitored. And the goal would be to have the opportunity to outperform an index when having more active management involved. So I say that index funds are great for investors that are going at it alone, that don't have the ability to really track it and monitor it and follow up on it daily. It's a great safe way to be diversified and make sure that you're not going to perform negatively to what the market might be doing. You're going to do about the same or whatever index you're mimicking is how you'll perform. But there is advantage to working with an advisor that has the ability to and the time and expertise to monitor a portfolio using other things, other types of investment classes other than just trying to track indexes.
Great. Another question. When you mentioned cash as a more smooth investment asset bucket like bonds, if I understand correctly, would you suggest investing in VMMXX along with VTSAX and VBTLX?
Okay, good question. I'm not going to speak specifically to particular investments, but I get the question. So generally speaking, cash is there's a place in everybody's portfolio for cash. All investors should have reserves. They should have emergency funds, something to fall back on in the event that you had a job change, an income fluctuation or change. And that's been even more important as we've been going through a pandemic, for an example. A lot of people are counting on those reserves to get through. So it's important to have a sound financial footing, and having a sound financial plan does have cash allocated for emergency funds, short-term expenses that you have coming up, something you don't want to have exposure to the market, but because you don't want to be taking that risk because you need the money for another purpose. The problem with interest rates being pulled near zero is there's not really anywhere to get any good interest on cash right now, but it still serves the purpose of having a reserve, because what good does it do if in the event that you need to access that reserve and you're all in the market and you have to pull it out of the market and the market might be being volatile at that period. It's better to have your cash on the side that you may need for emergency funds. With that said, you don't want to be too heavily in cash. You don't want to hold more cash than you need. Some of that money, if you're holding more than you need, could be put to work to helping you with your long-term goals. Cash is not going to hedge inflation. And as you sit there in cash, you lose purchasing power. So if you were to come into me and see me as, for an example, and I said to you, I'm going to put you in an investment that I guarantee you will lose 2 to 3% a year. You would say, no way, I'm not going to do that investment. Well, that can be cash if you look at the impact of loss of purchasing power due to inflation. So you want to have the right amount of cash for those reserves and those important emergency fund short-term needs. But you don't want to sit too much in cash, because of the portion that you don't need for those reserves simply won't hedge inflation, and it'll step back in value gradually over the years.
Great. Some insurance companies sell one company's insurance. Others represent multiple companies. Are financial advisors similar? One rep may just have one family of funds, but others represent multiple families?
It's a great question. There's so many different structures of how financial advisors work and the different umbrellas they work within. Just as I said earlier, the fees to investing can be very complex. So can how your financial advisor is structured. Some financial advisors are independent and don't have use any proprietary funds. There's also financial advisors that work for big companies that don't use proprietary funds. And then you've got some advisors that work for companies, and those companies have proprietary funds. You might see on your statement a title or a name of the company that you're working with is also the name on a title on a mutual fund, for an example. That would be a proprietary fund. So there's so many different structures. It's not a right or wrong. There's great financial advisors in every way you can be an advisor, every structure, every type of company. There's broker dealers and wirehouses and insurance companies. There's independents. So what's really key is to find a financial advisor you trust, that you vet, that you meet with, and that you have them explain to you what their structure is. All financial advisors have a legal obligation to be transparent about how they're compensated and what their conflicts of interest are. I think having a fiduciary advisor is key, somebody who has taken a legal oath to always act in the client's best interest, and looking for a financial advisor who will be open and honest with you about how they're compensated with the different investment products that they offer is also super important. But there's not a right or wrong. There's so many different ways advisors work in different umbrellas, and unfortunately it's what creates so much confusion. So doing your due diligence and doing your research and your homework before meeting with a financial advisor will help take a lot of that guesswork out of it, so that you can really get down to what financial advisor is going to be a right fit for you and one you can build trust and rapport with.
Great. What is your take on investment websites and products like Motley Fool and some of those that push out stock tips to people?
Yep. The number one thing I will say, and I've said it my entire career, if it sounds too good to be true, it probably is. And in the 17 years I've been doing this, I would say that has always been the truth. I have clients that will call and say, I've just read this article about this hot stock tip, or I just read something about this is the next best thing to be invested in. So you got to be very cautious about those types of investments and what's being pushed out there to the general public. For one, they're not evaluating what your situation is, what your risk tolerance, time horizon, or objectives are. They don't know what you're already invested in, and would your portfolio, would this complement your portfolio or not? They're just out there selling investments and pushing strategies. Some are good, more often they're not. So again, I would really look to stay with the tried and true investment companies if you're going to go at it alone, and not do anything that's on the fringe or not well known. And again, if it sounds too good to be true, it most likely is. So be very cautious about that as well. In terms of investment information you can get out there, I don't want to speak specifically to Motley Fool, but there's so many different publications that circulate. Often these publications, and there's many out there, are being compensated to push a certain product. It's just a sales avenue for them. It's not necessarily giving sound advice. So I would say really vet those investments that you're considering. And again, try to get some professional advice, can really help you from making some costly mistakes.
Great. At this moment, cash in a HYSA versus bonds, which is a better option?
It depends. Depends on your situation. It depends on the reason you're using short-term cash instruments and or bonds. It depends on a lot of things. There is not a black and white answer to that. You would have to, it depends on what the purpose of that investment is. Is it short-term? Is it long-term? Is it in a tax deferred or a taxable account? You can't just answer that question without knowing more information. Again, feel free to contact me. I'd be happy to know more about the person who's asking that question and provide better guidance.
Great. Any other questions from folks on the Zoom or on Facebook? Please ask it now if you're on the Zoom, or please put it in the comments on Facebook. I think you did a really good job at covering a very comprehensive list of investing questions, Amy. Thank you so much. I don't see that we have any other questions for you at this time, but this was a lot of great information. So thank you again. And do you want to just verbally say your email address? We will also put it out there.
Sure. It's Amy, or my email is amy@prevailwealth.com. And then I'll also put back up on here, whoops, oh, I just lost a chance to share. The other, if you guys want to have the opportunity to log on, just for those that have viewed this presentation, we have created a special web link for you. It's at www.prevailwealth/chamber.com. So prevailwealth/chamber.com. That will take you to a brief questionnaire to share more about yourself, and to a scheduling tool to schedule a 15-minute consultation on my calendar. And no obligation, no objective other than just to answer additional questions. It's been a pleasure to do this presentation. I hope I provided some guidance and insight to maybe information that is new to you. If you've been an investor for a while now, then maybe this was a refresher. So hopefully you found it valuable.
Wonderful. Thank you, Amy. Try sharing that screen one more time. You do still have permission. I don't know what happened there.
Okay, let me get back to the bottom. So here you go.
Okay. We see your deck.
Okay, so
there we
right
go.
at the bottom, yeah.
There you go. So you can go to that website and schedule your time with Amy. And thank you so much, everyone, for joining us. Thank you so much to Amy for doing this wonderful community education webinar. And join us next time for our next event.
Great. Thank you. Take care,
Thanks.
everyone.
Thank you, Amy.
You're welcome.